Market news now. Emerging market stocks fell heading into the holiday weekend on a lackluster note after strong U.S. economic data confirmed views that the Federal Reserve may need to be hawkish for longer. Initial jobless claims rose less than forecast in the week ended December 17th, underscoring the strength of the labor market. The third quarter gross domestic product figures were revised to 3.2% compared with a previously reported 2.9% advance on firmer spending. Meanwhile, locally, two subsidiaries of sugar giant Tongaat Hewlett have entered into business rescue 2 months after the holding company did the same. Tongaat Hewlett Sugar SA and animal feeds operation Furmol Feeds were wholly owned subsidiaries and have historically relied on Tongaat Hewlett for financial and operational support. Trading in the shares of the 130-year-old company, which went into business rescue on October 27th, remains suspended on the JSE. Meanwhile, ratings agency Fitch Solutions has warned that economic and social challenges will continue to weigh on SA consumer confidence in 2023 and says it continues to hold a negative view for the consumer outlook in South Africa over the following year. The agency expects inflation and interest rates to remain persistently high, which will weaken purchasing power and compound the pessimistic outlook for the short term. However, in the face of a relentless squeeze on consumers' pockets and interest rates rising substantially every 2 months, SA retail sales are holding up remarkably well. I spoke to independent retail analyst Chris Gilmore about the South African retail sector and his expectations for 2023.
It's interesting. If you look at it from an operational perspective, it hasn't been that bad. I'm talking about from the company's perspective. So, for example, TFG has done spectacularly well. Mr. Price has done okay. Even Woolworths, which has been an absolute dog for a long time, came in with some great results towards the end of its financial year. Pick n Pay's done okay. Shoprite's done exceptionally well. And yet, if you look at the share prices of virtually all of these companies, they're all languishing. TFG, which in my opinion is the best performing share amongst retailers out there, is trading at half of its peak from 2018. So it really is not reflecting, I don't think, what is actually going on there operationally. And you made mention of the consumer confidence. The FNB BER Consumer Confidence Index came out recently for the fourth quarter, and that improved significantly. Still in negative territory, admittedly, but improved dramatically compared to what it was in the second and the third quarters. And their interpretation, FNB BER's interpretation of that, is that consumers are looking much more confident, particularly younger consumers. So if they have the wherewithal to spend, they're going to spend. And I take that further. I would say that if they've got the capacity and the ability to take on more debt, and it's done responsibly, then I think we'll start seeing more credit being dished out in 2023.
So November we had, Black Friday, and I know we are expecting the stats for that, I think around mid-Jan, just to see the performance. Yeah. What are you hoping to glean from those figures? Are you expecting subdued performance?
Black Friday, in my honest opinion, I think is a big con. And it's been getting worse and worse and worse. And if you look, it started off maybe 10 years ago in South Africa, around about then, and it was a big deal. And people bought special things. It was a special occasion. But now, they're buying very much commodity items, things like diapers and stuff like that, and lots of them. So it's no longer the kind of special thing. And if you look at the kind of specials that are being offered by the retailers, there's no longer the kind of there's no longer the excitement that there was right at the very beginning. So yes, there'll be a bump, and make no mistake, for the past 2 or 3 years, they've extended Black Friday to pretty much incorporate the whole of November. So you're going to get a bit of a bump, but bear in mind when you compare it year on year against the previous November, where a similar thing happened, you're going to get a base effect coming in, so it may not look that profound.
The one key piece of news that stood out this week was Woolworths deciding that they're going to sell department store David Jones to the Australian Private Equity Fund. And when we look back at the journey that Woolworths has endured with David Jones, it's been a costly chapter for them. Your sense of this decision, and what do you make of it?
Well, look, we put out a note about 18 months ago saying precisely this, that not only should they sell David Jones, but they should sell the whole of Australia and go further than that. And they should actually split up the operation in South Africa into separate listings for food and FB&H, the clothing side. So as far as we're concerned, they've basically done half of the operation already. It's very good. Let me give them lots and lots of credit for getting rid of David Jones, because a total underperformer. It was never going to be part of their core business. They've destroyed huge shareholder value over the past 8 years, spent an awful lot of money, and they've got away. And we always knew they were going to get rid of it. And so that's very, very good. But now it allows them really to concentrate on the core business. And the core business is dominated by food, which they do exceptionally well. They do it far better than any other food retailer in South Africa, bar none. However, having said that, we discussed earlier, the consumer's under incredible pressure. So the food customers that are typical Woolies are going into Woolies and they're looking and thinking, I can't afford this any longer. It's just eye-wateringly expensive. The quality is fantastic. It really is. The quality is way above anything that any other retailer can get to. The cold chain isn't matched by anybody, but there's a price for everything. So I think what's going to happen is that Woolies are going to have to cut their prices. They use this funny old term, investing in price. They're going to have to do an awful lot of investing in price in 2023. And I think they will. And I've got a lot of faith in Woolies. If you look at the share price, the Woolies share price, it's actually done very, very well this year.
Right. Just for context, what is the difference between, David Jones and Country Road here? Because, I mean, David Jones, they're deciding to let go, but should they really go ahead with letting go Country Road?
Country Road is it's a highly iconic, high quality clothing manufacturer. And, you can get their products in some of the Woolies in Sandton, for example. And, yeah, it's been through the mill over the past 20-odd years that they've had ownership of this thing. And Ian Moyer, the previous CEO, he used to run Country Road. And I think that's one of the reasons why the Woolies board took him seriously when he persuaded them to go into to buy out David Jones, because he'd done so well with Country Road. But Country Road, it's a good operation, but it's never going to be a great operation. And I don't think it's ever going to be a big money spinner for them. Let me put it that way. So that's why I say I think it's something that they could probably do without it. It's a distraction.
Before I let you go, what are you going to be keeping an eye on when it comes to the retail sector, whether it's food retailers or the clothing retailers?
Number of things. Woolies, obviously, we'll have to see what happens there. But TFG, as they're doing all the right things. They're coming right in Australia. I mean, they're with a vengeance. They're coming right in the UK. They are taking market share away from everybody, and even Mr. Price in South Africa, and yet they haven't got credit for it. And I think a lot of investors are a little bit scared of the clothing retail sector at this point in time, because they think it's going to be a difficult year, and it is going to be a difficult year. But TFG have got the formula just so right, in my opinion.
That was independent retail analyst Chris Gilmore. That is it from me. After the break, we'll have SME On Point with Diabo Seto.